Top 25 Anti-Money Laundering (AML) Interview Questions and Answers. Welcome to our channel. If you're preparing for an anti-money laundering (AML) interview, you've come to the right place. In this video, we'll go through the top 25 AML interview questions and answers, explained clearly, confidently, and in simple language, to help you ace your next interview and land your dream AML role. 1. What is anti-money laundering (AML)? Anti-money laundering refers to the set of laws, policies, and procedures designed to prevent criminals from disguising illegally obtained funds as legitimate income. In simple terms, AML aims to detect, report, and stop suspicious financial activities that could involve drug trafficking, terrorism financing, or fraud. Financial institutions are required to implement strong AML programs including Know Your Customer, KYC, checks, transaction monitoring, and suspicious activity reporting. The ultimate goal is to preserve the integrity of the financial system by making it difficult for criminals to clean dirty money and inject it back into the economy undetected. 2. What are the 3 stages of money laundering? Money laundering typically involves 3 key stages. Placement, where illegal funds enter the financial system, for example through deposits or cash purchases. Layering, where multiple transactions or transfers are made to obscure the source of the funds. Integration, where the funds are reintroduced into the economy as apparently legitimate assets. A good AML analyst must understand how to identify red flags at each stage. For example, unusual cash deposits, placement, complex international transfers, layering, or sudden investments in property, integration, can all indicate suspicious behavior that should be reported. 3. What is the difference between AML and KYC? KYC, Know Your Customer, is a subset of AML. While AML refers to the overall framework for combating financial crime, KYC focuses specifically on verifying the identity of customers before and during their business relationship. KYC ensures financial institutions know who their clients are, where their funds come from, and whether they pose a risk. AML encompasses KYC along with transaction monitoring, sanction screening, suspicious activity reporting, and record keeping. In short, KYC is one pillar of AML. You can't have an effective AML program without a strong KYC process in place. 4. What is CDD and EDD in AML? Customer due diligence, CDD, is the process of identifying and verifying customers to assess their risk profile. It includes checking identification documents, verifying addresses, and understanding the nature of a customer's business. Enhanced due diligence, EDD, applies when a customer poses higher risk, for example, politically exposed persons, PEPs, offshore clients, or those from high-risk jurisdictions. EDD involves deeper checks like source of funds verification, transaction pattern reviews, and ongoing monitoring. The purpose of both CDD and EDD is to ensure that organizations understand their customers well enough to detect suspicious activities early. 5. What is the role of a money laundering reporting officer, MLRO? The MLRO is responsible for overseeing a company's AML program. Their duties include receiving and reviewing internal suspicious activity reports, SARs, determining whether to escalate them to the regulator, maintaining AML policies, training employees, and ensuring regulatory compliance. They act as the main point of contact between the institution and law enforcement agencies. A successful MLRO must have strong analytical skills, up-to-date knowledge of laws, and the confidence to make critical compliance decisions even under pressure. 6. What is a suspicious activity report, SAR? A suspicious activity report, SAR, is a formal document submitted to the relevant authority, such as FinCEN in the US or NCA in the UK, when a financial institution detects potential money laundering or terrorist financing activity. SARs must include details of the transaction, involved parties, and reasons for suspicion. Filing a SAR doesn't mean the transaction is proven illegal, it simply alerts authorities for further investigation. Timely SAR reporting is one of the most critical obligations under AML law, and failure to report can result in heavy penalties. 7. What are red flags in AML monitoring? Red flags are warning signs indicating possible money laundering. Examples include frequent large cash deposits inconsistent with customer profile, sudden international transfers to high-risk countries, structuring transactions just below reporting thresholds, unusual third-party payments or shell companies. AML analysts must analyze transaction patterns and customer behavior to detect these anomalies. However, context is important. Not all red flags indicate crime. The key is to investigate patterns, not isolated events, and document findings thoroughly. 8. What is transaction monitoring? Transaction monitoring involves continuously analyzing financial transactions to detect patterns or behaviors that may indicate suspicious activity. Modern AML systems use automated software powered by machine learning and risk-based rules to flag potential issues. Analysts then review these alerts to decide whether further investigation or ASAR is necessary. Effective transaction monitoring ensures organizations comply with regulatory obligations while minimizing false positives that waste time and resources. 9. What is a politically exposed person, PEP? A PEP is an individual who holds or has held a prominent public position, such as a government official, ambassador, or senior military officer. Because of their influence, PEPs are considered high-risk customers. They may be vulnerable to bribery, corruption, or misuse of funds. Financial institutions must perform enhanced due diligence, EDD, for PEPs, including verifying the source of wealth, monitoring ongoing transactions, and performing regular reviews. Family members and close associates of PEPs are also subject to these checks. 10. What are sanctions and sanction screening? Sanctions are restrictions imposed by governments or international bodies, like the UN, OFAC, or EU, against specific countries, entities, or individuals involved in illegal activities such as terrorism or human rights violations. Sanction screening involves checking whether customers, transactions, or counterparties appear on these lists. Financial institutions must use updated screening tools to prevent prohibited dealings and report any matches immediately. Ignoring sanctions compliance can lead to severe fines, reputational damage, and criminal liability for both the company and individuals involved. 11. What is the FATF and its role in AML? The Financial Action Task Force, FATF, is an intergovernmental organization established in 1989 to develop global standards for combating money laundering and terrorist financing. FATF issues recommendations, conducts mutual evaluations of member countries, and publishes gray lists and blacklists identifying jurisdictions with weak AML controls. Its guidance helps ensure a unified international approach to financial crime prevention. Financial institutions often align their policies with FATF standards to ensure global compliance consistency. 12. What is the difference between AML and CFT? AML stands for Anti Money Laundering, focusing on stopping criminals from legitimizing illegal funds. CFT, or countering the financing of terrorism, aims to prevent funds from being used to support terrorist activities. While both overlap in purpose and procedures, such as KYC, transaction monitoring, and reporting, CFT may target even small transactions linked to suspicious entities. Together, AML and CFT frameworks create a robust defense system against financial crimes and threats to global security. 13. What is risk-based approach in AML? The risk-based approach, RBA, means prioritizing resources and controls according to the level of money laundering risk each customer, product, or region presents. For example, a politically exposed person or offshore client may require enhanced due diligence, while a low-risk domestic customer may only need standard checks. RBA ensures compliance teams focus on higher-risk areas, improving efficiency and effectiveness. This principle is endorsed by FATF and is a cornerstone of modern AML frameworks worldwide. 14. What are high-risk jurisdictions? High-risk jurisdictions are countries identified as having weak AML, CFT controls, high corruption, or lack of cooperation with FATF standards. Financial institutions must apply enhanced monitoring and due diligence when dealing with clients or transactions involving these regions. Examples often include nations on FATF's gray or black list. By being aware of these regions, AML analysts can better assess geopolitical risks and ensure that no part of their organization indirectly supports illicit activity. 15. What are the key components of an effective AML program? An effective AML program includes 1. Written policies and procedures. 2. Appointed compliance officer, MLRO. 3. Ongoing employee training. 4. Risk-based customer due diligence. 5. Transaction monitoring and reporting. 6. Independent audits. These elements work together to detect and prevent financial crime. A strong AML program also promotes a culture of compliance, where every employee understands their role in protecting the institution and its customers. 16. What is beneficial ownership? Beneficial ownership refers to the person who ultimately owns or controls a customer or entity, even if the legal ownership appears under another name. For example, a shell company might list several directors, but the beneficial owner is the individual who enjoys the financial benefits. Identifying beneficial ownership helps prevent anonymous structures from being used to launder money. Regulations often require firms to maintain accurate, up-to-date ownership records and verify this information during onboarding and periodic reviews. 17. What is structuring or smurfing? Structuring, also called smurfing, is a technique where criminals break large sums of illegal money into smaller deposits to avoid detection or reporting thresholds. For instance, instead of depositing $50,000 at once, someone may make 10 deposits of $5,000 each. AML professionals use transaction monitoring tools to spot such patterns. Recognizing structuring is critical. It's one of the most common money laundering methods and a key reason why institutions must analyze transaction behavior over time, not just single events. 18. What is correspondent banking risk? Correspondent banking occurs when one financial institution provides services to another, often across borders. While it enables global trade, It also introduces risk because one bank may rely on another's AML controls. If the respondent bank has weak due diligence, criminals could exploit the system. To manage this, regulators require enhanced due diligence on correspondent relationships, including understanding ownership structure, AML policies, and ongoing transaction monitoring. 19. What is the purpose of record keeping in AML? Record keeping ensures that all customer information, transactions, and due diligence documents are retained for a legally specified period, often 5 years or more. These records enable authorities to trace criminal funds, support investigations, and verify compliance. Failure to maintain proper records can result in regulatory fines and reputational damage. Accurate record keeping isn't just a compliance task, it's a key defense mechanism against organized financial crime. 20. What are AML red flags in cryptocurrency transactions? With the rise of digital assets, AML red flags in crypto include large or rapid transfers between wallets with no clear business reason, use of privacy coins or mixing services, transactions involving sanctioned jurisdictions, frequent conversion between fiat and crypto. AML professionals must stay updated on blockchain analytics tools that track and trace crypto transactions, ensuring compliance with evolving regulations like FATF's travel rule. 21. How often should AML training be conducted? AML training should be ongoing, typically annually or more frequently for high-risk teams. It must cover recent regulatory changes, internal procedures, and real-world case studies. The goal is to ensure all employees, from frontline staff to management, can recognize and report suspicious behavior. Regular training reinforces a compliance-driven culture, reduces human error, and demonstrates to regulators that the institution takes AML obligations seriously. 22. What is Wolfsburg Group and its importance? The Wolfsburg Group is an association of 13 global banks that develop financial industry standards for AML and CFT. They issue principles and best practices, such as the Wolfsburg AML questionnaire, used by institutions to assess correspondent banking partners. Their guidance complements FATF recommendations and provides practical frameworks for global institutions to manage financial crime risks effectively. Referencing Wolfsburg standards in interviews shows awareness of international compliance benchmarks beyond local regulations. 23. How do you handle a false positive alert in transaction monitoring? False positives occur when a monitoring system flags legitimate transactions as suspicious. When this happens, the analyst must review the alert thoroughly, verify customer information, check historical patterns, and document reasoning before closing it. The goal is to maintain accuracy and traceability in decisions. Reducing false positives improves operational efficiency while ensuring true risks are never missed. Good analysts balance vigilance with judgment, investigating carefully but avoiding unnecessary escalations. 24. How do you stay updated on AML regulations and trends? Staying informed is essential in AML roles. Professionals should follow regulatory updates from FATF, FinCEN, FCA, and OFAC. Attend AML webinars, certification courses, and professional forums. Subscribe to compliance newsletters or industry sites like ACAMS Today. Continuous learning demonstrates commitment and expertise, qualities that employers value highly in compliance professionals. 25. Why do you want to work in the AML field? A strong personal answer might be, I'm passionate about protecting the integrity of the financial system. AML work allows me to combine analytical thinking with real-world impact, helping stop crimes like fraud, corruption, and terrorism financing. I also enjoy continuous learning since regulations and technologies evolve constantly. I believe my attention to detail and sense of responsibility make me well suited for this field. This shows purpose, ethics, and enthusiasm, exactly what interviewers look for. And that wraps up our top 25 anti-money laundering interview questions and answers. If you found this video helpful, don't forget to like, comment, and subscribe for more detailed interview preparation guides. Remember, AML isn't just a job, it's a mission to protect our financial world from crime and corruption. Good luck with your upcoming interview, and keep learning, keep growing, and keep making a positive difference in compliance.